Welcome to our deep dive into the investment strategies of one of the most successful investors of all time, Warren Buffett. In this audiobook summary, we'll break down key chapters from The Warren Buffett Way by Robert G. Hagstrom and uncover the timeless principles that have helped Buffett build a multi-billion-dollar empire. Whether you're new to investing or looking to refine your strategy, these lessons are a must-watch. When you think about investing, what comes to mind? For many, it's the stock market, charts, numbers, and lots of short-term action. But Warren Buffett, one of the most successful investors of all time, sees it very differently. To him, investing is about buying into businesses, not just stocks. And that's the first lesson we learn in Chapter 1 of The Warren Buffett Way. Investing is a business, not a gamble. Buffett's investing philosophy centers around understanding the businesses you invest in. Rather than focusing on daily stock price movements or trying to time the market, he emphasizes the importance of seeing the business behind the stock. This idea may seem simple, but it's crucial for becoming a successful long-term investor. Before diving into the details of what makes a great investment, Buffett draws a key distinction between investing and speculation. While speculation is based on trying to predict short-term price movements, investing is about owning a piece of a company for the long haul. Imagine you're buying stock in a company. If you view the stock as a piece of the company, you'll care about the company's long-term health, growth, and earnings. If you're speculating, however, you might only care about what happens to that stock price in the next few days or weeks. For Buffett, true investing is about understanding the intrinsic value of a company based on its earnings potential, competitive position, and long-term prospects. It's about knowing that even if the market fluctuates, the underlying business will continue to generate value over time. Speculators, on the other hand, are focused on market trends and often let emotions dictate their decisions. Warren Buffett believes that successful investors need to think like business owners, not just stock traders. That means instead of looking for a quick profit or hoping for a sudden price spike, you should ask yourself, would I want to own this business for the next 10 years? Does the company have a solid track record and future potential? Is the business model sustainable over time? For example, imagine you're interested in a company like Coca-Cola. Rather than worrying about daily stock price movements, ask, if I own this company, how would I feel about it in the long term? If you think that the business will continue to thrive and that the brand will remain strong, then you've got a solid investment. If you don't feel confident, it might be better to pass. Buffett advises that investors should only invest in companies they understand thoroughly. This doesn't mean you need to know everything about a business, but you should have a clear idea of how it operates, makes money, and competes in the market. If you don't understand the business, you're essentially gambling. So when you're looking to invest, it's crucial to stick to what you know. If you're a tech expert, maybe technology stocks are your thing. If you've worked in retail for years, retail companies might be easier for you to analyze. A major point Buffett emphasizes in this chapter is the importance of business quality over stock price. The price of a stock is a reflection of what the market believes a business is worth right now. You're based on short-term factors. But the real value of a business is rooted in its long-term earning potential, competitive advantage, and financial health. In other words, buying the stock price is not the same as buying the business. Buffett urges investors to focus on the quality of the company, its business model, and long-term prospects. A core principle in Buffett's philosophy is long-term investing. He believes that the best way to make money in the stock market is to buy high-quality businesses at reasonable prices and then hold them for the long run. Think of it like planting a tree. When you first plant it, it doesn't give you much shade or fruit. But over time, with the right care and patience, the tree grows strong, and eventually it provides shade and fruit for years to come. The same is true of investing. If you buy into a solid business and hold it for years or even decades, you can watch your investment grow steadily, reaping the rewards of its success. One of the biggest challenges for investors is staying calm during market fluctuations. Buffett stresses the importance of maintaining your focus, especially during periods of volatility. The stock market will always have ups and downs, but over time, the companies that are well managed and have strong business models will continue to thrive. While investing is about sound judgment, patience, and understanding the underlying business, speculation is driven by short-term price movements and often based on emotions, not logic. Buffett firmly believes that anyone who approaches the stock market with the intention of making quick profits is not investing at all. They're speculating. And according to Buffett, speculators have a much higher chance of losing money. The intelligent investor, on the other hand, is disciplined, thoughtful, and makes decisions based on a thorough analysis of a company's fundamentals. Let's start by examining speculation because it's easy to confuse with investing, especially in a market that often rewards short-term gains. Speculators are people who try to make money based on short-term price movements. They might follow market trends, try to predict the next hot stock, or bet on sudden market shifts. Speculation can be thought of as gambling. In both gambling and speculation, the person making the bet is hoping for a payoff, but neither approach has a solid foundation of understanding or careful analysis. It's driven more by the hope of hitting it big than by a well-thought-out plan. Now let's turn to the other side of the coin, the intelligent investor. Unlike a speculator, the intelligent investor approaches the market with a clear, structured mindset. Rather than chasing short-term gains, they focus on long-term value. For Buffett, the intelligent investor has certain key characteristics. Patience. The intelligent investor is in no hurry. They know that building wealth through investments takes time, and they're willing to wait for the right opportunities. Understanding. They invest only in businesses they understand thoroughly. If they don't understand how a company makes money or how it competes in its market, they stay away. Discipline. The intelligent investor has a set of criteria they stick to. They don't let emotions, market trends, or short-term fluctuations dictate their decisions. Focus on value. The intelligent investor is concerned with the intrinsic value of a company, the underlying worth based on its earnings, competitive advantage, and long-term potential, rather than the daily fluctuations in its stock price. Buffett introduces an interesting concept, Mr. Market. He uses this character to help explain how the stock market works and how an intelligent investor should interact with it. Mr. Market is a fictional character who is a bit irrational. One day he's in a great mood, offering you a fair price for your stocks, and the next day he's panicking and offering ridiculously low prices. Mr. Market's moods can seem random and erratic. The intelligent investor, Buffett argues, should not be swayed by Mr. Market's emotions. Instead of acting impulsively, the investor should take advantage of the market's irrationality. When Mr. Market is overly optimistic, offering inflated prices, the intelligent investor might sell. When Mr. Market is down and pessimistic, offering undervalued stocks, the intelligent investor might buy. This approach requires patience and discipline, as it's easy to get swept up in the market's mood swings. The key is understanding that the market's short-term fluctuations are often not reflective of the long-term value of a business. One of the biggest dangers of speculation is that it's heavily driven by emotions, fear and greed being the primary culprits. Speculators often buy because they're afraid of missing out, FOMO, or sell because they fear losing more money during a downturn. Emotions can cloud judgment and lead to poor decision-making. For example, when the market is rising rapidly, it's easy to get caught up in the excitement and make risky bets. But this behavior often leads to bad outcomes, as speculators end up buying high and selling low. In contrast, intelligent investors are emotionally detached from their investments. They understand that market downturns are normal and that true value is found in companies that are well managed, have strong earnings, and a solid competitive position. They don't panic when prices drop. They simply see it as an opportunity to buy undervalued stocks. Buffett's version of value investing is about finding stocks that are trading below their intrinsic value, stocks that are cheap in relation to their real worth. But this doesn't mean just looking for cheap stocks based on price. Instead, it's about analyzing a company's fundamentals, its earnings potential, its competitive advantages, and its future growth prospects. Buffett's strategy involves buying businesses with a margin of safety, meaning there's a built-in cushion if the business doesn't perform as expected. This approach helps protect against the risk associated with speculation. Buffett's investment philosophy revolves around investing in businesses that you understand. He famously avoids investing in things like technology stocks because he doesn't fully understand the intricacies of the tech industry. Instead, he focuses on businesses in industries he knows well, like consumer goods, insurance, and utilities. The key takeaway here is that knowledge is power when it comes to investing. If you don't understand the business model, the competitive landscape, and the potential risks, you're not investing. You're speculating. In today's market, speculation has become even more prevalent with the rise of day trading and the explosion of new investment options like cryptocurrencies. Many people are now drawn to these markets, hoping to make quick profits from price swings. Buffett has been critical of these trends, warning that these types of speculative investments have no real value behind them. For example, he has publicly criticized Bitcoin, arguing that it's a speculative asset without any intrinsic value. He believes that investors are buying into these markets because of hope and speculation, not based on any true understanding of the underlying assets. Buffett believes that a great business model is one that allows a company to generate high returns on invested capital, maintain a competitive edge, and keep growing year after year. A strong business model doesn't just depend on one-time success. It is about creating a system that can continue to produce value for the company and its investors over the long term. But what exactly makes a business model strong? Key elements of a strong business model include a durable competitive advantage. This is often referred to as an economic moat, something that protects the business from competitors. Whether it's brand strength, network effects, regulatory advantages, or a unique product. A strong moat ensures that a company can maintain profitability even in the face of competition. Scalable and repeatable revenue streams. Businesses with predictable and repeatable revenue models tend to perform better in the long run. For example, subscription-based services or companies that rely on repeat customers often see more stability than businesses with one-time transactions. Efficient operations. A company's operations should be streamlined and efficient, allowing it to produce goods or services at lower costs and generate higher profits. Financial strength. A strong business model is supported by a robust financial structure with healthy margins, manageable debt, and consistent cash flow. One of the most powerful concepts Buffett uses to evaluate companies is the economic moat, a term Buffett borrowed from medieval times when a moat was used to protect castles from invaders. In a business terms, a moat is anything that protects a company from competition and allows it to maintain a strong market position. There are several types of moats that a company might have, and Buffett has often said that the wider the moat, the more attractive the investment. Let's take a look at some of the most common types of moats. Brand power. A strong brand can act as an impenetrable moat, allowing a company to charge premium prices and maintain customer loyalty. Think of companies like Coca-Cola, Apple, or Nike. Their brands are so strong that they can command high prices and still have a loyal customer base that continues to buy their products, even when competitors may offer similar goods at lower prices. For an example, Coca-Cola has one of the strongest brands in the world. People are willing to pay more for a Coke because they trust the brand and associate it with quality and consistency. The brand itself acts as a moat, protecting Coca-Cola from cheaper alternatives. Network effects. Some companies benefit from network effects where the value of their product or service increases as more people use it. For example, Facebook or Google. The more users these platforms have, the more valuable they become to everyone. Cost advantages. Companies that can produce goods or services at lower costs than competitors have a significant edge. This often comes from economies of scale or proprietary technology that allows a company to produce more efficiently. For an example, Walmart is a prime example of a company with a cost advantage. Because it operates on such a large scale, it can buy products in bulk and pass on the savings to customers. This allows Walmart to maintain low prices, which in turn helps them capture more market share and fend off competition. Regulatory advantages. In some cases, regulations can create a moat by limiting the number of competitors in an industry. For example, utility companies or pharmaceutical companies that hold exclusive licenses or patents. Another essential feature of a strong business model is its ability to scale. Scalability refers to a company's ability to grow without significantly increasing its costs. This is crucial because scalable companies can grow rapidly and profitably. For Buffett, scalability is a sign of a company that has room to grow its profits over time. Companies that can scale quickly have a huge advantage because they can increase revenue without a corresponding increase in expenses, leading to improved margins. Buffett is particularly fond of businesses that generate repeat revenue. A business model based on recurring revenue streams is far more attractive to Buffett than a model based on one-time sales. Companies that sell products or services that customers use repeatedly tend to be more stable and predictable. Examples include subscription-based models, like Netflix or SaaS companies, consumable products like toiletries, cleaning supplies, or groceries, services that customers rely on regularly, like insurance or utilities. For example, Apple's App Store generates consistent revenue from both developers and customers. Every time an app is downloaded or purchased, Apple receives a cut, This creates a steady stream of income that's less susceptible to economic downturns. When Warren Buffett looks at a company, he's focused on understanding how the business makes money and whether that process is sustainable over time. He looks for businesses that have a strong competitive position, can generate profits with a solid track record, and have room to grow. He also looks for predictable earnings, companies that are able to generate consistent profits, even in times of economic uncertainty. Businesses that depend on unpredictable factors, like the price of oil or the health of the economy, are far less attractive to Buffett. A common mistake that many investors make is to focus on short-term growth, often chasing the hot stock of the moment. However, Buffett cautions against this approach, as it can lead to poor long-term outcomes. A company with a weak business model may experience rapid growth in the short term, but without a sustainable competitive advantage, that growth is unlikely to last. The Warren Buffett Way, we delve into one of the most important concepts in value investing, the margin of safety. This principle, popularized by Benjamin Graham, is all about buying securities at a price significantly below their intrinsic value. The idea is that by purchasing an asset at a discount, you create a buffer against unforeseen risks or errors in your analysis. For Buffett, the margin of safety is a key part of his investment strategy. It helps protect the investor from making costly mistakes while also allowing for potential gains when the market eventually realizes the true value of a company. The core idea behind the margin of safety is risk reduction. Investing in a company that is trading at a price far below its intrinsic value gives you a cushion if things go wrong. If the company's performance isn't as expected or the market fluctuates, the margin of safety means you're less likely to lose money. Let's say you calculate that a company is worth $100 per share based on its fundamentals. If you can buy it for $60 or $70 per share, you have a built-in cushion that protects you in case your valuation was off, or the market doesn't recognize the company's value right away. Buffett has often cited his Coca-Cola investment as an example of the margin of safety at work. In the late 1980s, Buffett invested in Coca-Cola when its stock was undervalued compared to its intrinsic worth. He wasn't betting on short-term market movements. Instead, he saw the long-term potential of the business and bought it at a price that offered him a margin of safety. Even if things didn't go perfectly with Coca-Cola's business operations, the stock price was low enough to offer a cushion for the investment. Over time, the market realized Coca-Cola's true value, and Buffett reaped the benefits. To apply the margin of safety, investors need to estimate the intrinsic value of a company based on its earnings, growth potential, and competitive advantage. Once you have that estimate, you compare it to the market price. For example, if you think a company is worth $100 per share, but the stock is trading at $60, you have a 40% margin of safety. If the stock is trading at $90, your margin of safety is smaller, at just 10%. Buffett prefers to invest in companies where there's a large margin of safety because it lowers the risk of losing money while still providing the potential for substantial returns. The margin of safety is more than just a strategy for reducing risk. It's also a way to focus on long-term value. When you buy a company at a significant discount, you're less likely to get caught up in the day-to-day market fluctuations and more likely to see the company's value realized over time. Buffett looks for companies with a wide economic moat, those that have durable competitive advantages that are hard for others to replicate. The wider the moat, the better the company is positioned to sustain high returns over time. Buffett identifies several types of moats that can protect a company. Brand power. A strong brand can create customer loyalty and allow a company to charge higher prices. Think of companies like Coca-Cola or Apple. Their brand strength gives them a competitive edge and allows them to maintain pricing power. For an example, Apple's brand is so strong that it can maintain high prices for its products, and customers will continue to buy them due to the perceived quality and value of the brand. Cost advantages. Companies with lower production costs can offer competitive prices while maintaining strong margins. Walmart is a good example of a company with a cost advantage, as its scale allows it to purchase goods at a discount and pass those savings on to customers. Network effects. Some companies benefit from network effects, where the value of their service increases as more people use it. This is common in tech companies like Facebook or Google, where more users make the platform more valuable. For an example, Facebook becomes more valuable as more people join because the platform grows in content and social connections. Switching costs. When customers face high switching costs, it makes it harder for competitors to take them away. Microsoft and Oracle benefit from this type of moat, as businesses invest heavily in their software, and switching to another platform is costly and time-consuming. Buffett stresses that companies with strong economic moats tend to generate sustained profits and can withstand competition over time. A moat not only helps companies maintain their market position, but also helps them protect their pricing power, which leads to higher margins and long-term growth. Warren Buffett stresses the importance of strong management and a healthy corporate culture in determining the success of a business. While a solid business model and competitive advantages are crucial, it's the management team that ultimately drives a company's performance over time. Buffett looks for leaders who are not only talented, but also aligned with the company's long-term interests, ethical in their decisions, and focused on creating value for shareholders. Buffett's ideal managers are honest and transparent, managers who are open about the company's strengths, weaknesses, and challenges. They don't hide bad news and are upfront with shareholders. Shareholder-oriented. Buffett values managers who think like owners. He prefers leaders who view the company's stock as their own investment, not just a job. This alignment ensures they make decisions that benefit shareholders in the long run. Competent and capable. While good ethics are important, Buffett also values managers with the skills and vision to run the business efficiently. A capable team can scale the company and adapt to changing market conditions. Buffett believes that a strong corporate culture is essential for long-term success. The right culture fosters employee engagement. When employees are motivated and aligned with company goals, productivity and loyalty increase. Decision-making autonomy. Buffett likes companies where managers are empowered to make decisions quickly without excessive bureaucracy. Buffett's own company, Berkshire Hathaway, is a prime example of his management philosophy in action. He gives his managers autonomy to run their businesses, but holds them accountable for performance. This decentralized approach allows for flexibility and quick decision-making while maintaining strong oversight. Buffett reinforces a key idea. Stocks are ownership in businesses, not just pieces of paper to be bought and sold for short-term gains. Instead of focusing on the daily fluctuations in stock prices, investors should think of buying stock as purchasing a part of the underlying company. Buffett treats every stock he buys as if he's buying the entire business. His goal is to invest in companies with solid fundamentals, strong management, and a proven ability to generate profits over time. When you own stock in a business, you should be thinking about the company's long-term health and growth, not short-term market movements. Buffett's strategy relies on finding businesses with long-term value. He focuses on buying with the intention to hold for years or even decades, allowing the company to grow and increase in value. This mindset reduces the temptation to make speculative, short-term trades based on market noise. Buffett emphasizes one of his most fundamental principles: patience. Investing successfully is not about quick gains or reacting to every market movement. It's about waiting for the right opportunities and giving your investments time to grow and reach their full potential. Buffett often says that the best time to invest is when you have a high level of confidence in the business and its long-term prospects, not when you feel pressure to act quickly because of market trends. Buffett warns against trying to time the market, the practice of buying and selling based on predictions of short-term price movements. He argues that nobody can consistently predict market movements, and the more time spent worrying about the market, the less focus there is on growing wealth in the long run. Instead, Buffett advises that investors focus on buying strong businesses at reasonable prices, and then allow those investments to grow over time. A key part of Buffett's patience philosophy is the power of compound interest. By giving your investments time to grow, the returns start to compound, meaning you earn returns not only on your original investment, but also on the earnings it has generated. This is why Buffett believes in holding investments for the long term. The longer you wait, the bigger your returns. Buffett has often said that investors should wait for the fat pitch, the perfect opportunity to make a great investment. Like a baseball batter waiting for a good pitch, you should be patient and only invest when you find an opportunity that meets your criteria. Buffett believes that acting impulsively on less than ideal opportunities often leads to poor results. Patience allows investors to wait for the right opportunities, rather than feeling pressured to invest in whatever is popular at the moment. Robert Hagstrom explores one of Warren Buffett's most central investing philosophies: the importance of a long-term focus. While much of the investment world is obsessed with short-term fluctuations in stock prices, Buffett believes that focusing on long-term growth is the key to building substantial wealth. Buffett's approach flies in the face of traditional stock market behavior, where investors often react impulsively to short-term price movements. Instead of obsessing over quarterly earnings or daily stock prices, Buffett encourages investors to think of stocks as ownership stakes in businesses, where the goal is to let the business grow and compound over time. In today's stock market, short-term thinking is rampant. Investors often focus on quarterly results, short-term earnings reports, and rapid market movements. This creates a culture where companies are pressured to deliver immediate results, sometimes at the expense of long-term growth and sustainability. Buffett warns against this short-term mentality, which often leads to decisions based on immediate market reactions rather than the fundamental value of the business. He argues that the stock market is full of noise that can distract investors from making decisions that will lead to long-term success. For Buffett, adopting a long-term perspective offers several key benefits. Compounding of returns. The power of compounding is one of the most potent forces in investing. When you invest in a business that is growing over time, you benefit not only from its current earnings, but also from the reinvestment of those earnings to generate even more growth. This compound growth is what turns a solid investment into significant wealth over the long term. Avoiding emotional decision-making. Short-term market fluctuations are often driven by emotion, fear, and greed. Investors may panic during market downturns, selling off their holdings at a loss. Conversely, they might get overly excited during bull markets, chasing stocks that have become overpriced. A long-term focus helps investors avoid these emotional pitfalls and stay grounded in the underlying value of their investments. During the 2008 financial crisis, Buffett famously bought stocks when others were panicking and selling. His long-term focus allowed him to take advantage of bargains when everyone else was too fearful to invest. Those decisions paid off handsomely as the market recovered. The importance of staying the course. When investors adopt a long-term mindset, they are more likely to stay the course during inevitable periods of market volatility. The short-term ups and downs of the market are simply noise, and by focusing on the long-term fundamentals of the companies they've invested in, they can ignore temporary distractions and remain focused on their long-term goals. Short-term investors typically focus on immediate price movements, seeking to buy low and sell high in the shortest possible time frame. Long-term investors like Buffett see stocks as ownership stakes in businesses and focus on the future potential of those businesses. Short-term view. Investors who focus on short-term price movements often try to time the market by making decisions based on short-term predictions. This can lead to erratic buying and selling, and often results in lower returns due to transaction costs, taxes, and missed opportunities. Long-term view. Investors who focus on long-term growth look at the fundamentals of a business, its earnings power, competitive advantage, and management. These investors understand that market fluctuations are temporary and that long-term growth is driven by the company's ability to create value over time. Buffett's long-term focus is closely tied to his focus on businesses with durable competitive advantages. These companies are well-positioned to continue growing and generating profits over time, regardless of short-term market conditions. Hagstrom reviews the major lessons from Warren Buffett's extensive investment history, highlighting key principles and strategies that have led to his success. Buffett's investment journey is not just a series of transactions. It's a reflection of his core philosophy and discipline in choosing investments. Lesson 1. Focus on intrinsic value, not market sentiment. One of the central themes from Buffett's investment history is the importance of intrinsic value. Buffett does not make decisions based on market trends or speculation. Instead, he focuses on businesses with strong fundamentals that are undervalued by the market. His success has largely stemmed from investing in businesses that had a clear path to long-term profitability. Lesson 2. Stick to what you know. Buffett is known for staying within his circle of competence. He invests in industries and businesses that he understands deeply, avoiding sectors or companies that are too complex or outside his expertise. By focusing on what he knows best, Buffett has been able to make more informed and confident investment decisions. Lesson 3. Patience and discipline. Buffett's history shows that the key to successful investing is patience. He often buys companies with the plan to hold them for decades. The idea is that market fluctuations and short-term volatility don't affect the long-term value of a high-quality business. Discipline is essential to avoiding the temptation of quick profits and staying focused on long-term growth. Lesson 4. The importance of strong management. Buffett's most successful investments have been in companies with strong, ethical management teams. He looks for honesty, competence, and long-term thinking in the leadership of companies. Buffett has repeatedly emphasized that good management is often more important than the business itself in determining long-term success. Lesson 5. The value of a margin of safety. A core lesson from Buffett's investment history is the margin of safety, buying companies at a significant discount to their intrinsic value. This protects investors from unforeseen risks and provides a cushion in case the investment doesn't perform as expected. Lesson 6. Be contrarian when others are fearful. Buffett's history demonstrates his ability to invest against the crowd. During periods of market pessimism, such as during the 2008 financial crisis, Buffett bought shares in companies that were undervalued. His contrarian approach allows him to take advantage of opportunities that others overlook or avoid out of fear. Hagstrom shifts the focus to applying the Buffett way to your own investments. He lays out how individual investors can take Buffett's principles and incorporate them into their investment strategies to achieve long-term success. Step 1. Focus on businesses, not stocks. The first step in applying the Buffett way is to think of stocks as ownership in businesses. Instead of focusing on short-term stock price movements, treat each stock as a piece of a business you plan to own for the long term. Understand its fundamentals, its earnings, its competitive position, and its management. Step 2. Buy quality businesses at a fair price. Buffett doesn't look for cheap stocks. He looks for quality businesses that are priced at a discount to their intrinsic value. He prefers to buy businesses with strong competitive advantages, economic moats, and management teams that are aligned with shareholders. When looking for investments, focus on businesses with sustainable profitability and long-term growth potential. Step 3. Maintain a long-term perspective. Adopt a long-term mindset. Buffett is known for his ability to hold on to investments for decades, allowing the companies he invests in to grow and compound. Don't get distracted by market volatility or short-term price swings. Instead, focus on the long-term performance and fundamentals of the business. Step 4. Be patient and disciplined. Patience and discipline are central to the Buffett way. You should wait for the right opportunities to come along and not feel pressured to invest in every market trend or hot stock. Don't chase after short-term profits or follow the herd. Instead, focus on quality businesses, wait for the right entry points, and hold on for the long haul. Step 5. Create a margin of safety. Buffett's principle of a margin of safety means buying stocks at a significant discount to their intrinsic value. This buffer reduces your risk in case things don't go as planned. When evaluating potential investments, make sure that the price is low enough to provide a cushion against market fluctuations or unexpected setbacks. Step 6. Keep costs low and understand your investments. Buffett stresses the importance of keeping investment costs low. Avoid frequent trading and unnecessary fees, as these erode long-term returns. Also, ensure that you thoroughly understand every investment you make. You should never invest in something you don't understand, as it adds unnecessary risk to your portfolio. Step 7. Invest in yourself. Buffett often talks about the importance of investing in yourself. The more you learn, the better equipped you are to make informed, intelligent decisions. Whether it's reading, taking courses, or learning from experienced investors. Self-education is key to improving your investing ability. If you found these insights valuable, don't forget to hit that like button. Share this video with friends or fellow investors who could benefit from the wisdom of Warren Buffett. And for more content like this, make sure you subscribe to the channel so you never miss an update.